an estimated 5.3% in 2025 and are projected to grow at 5.4% in 2026 and 5.6% in 2027, which is comfortably higher than the sub-Saharan African average of 4.5 in 2025, 4.3 in 2026, and 4.4% projected for 2027. Sustaining this momentum is going to require continued prudent macroeconomic management and closer fiscal monetary policy coordination to help our economies withstand any future shocks. Notwithstanding the headwinds from global conditions, the exchange rates in the East African countries remain broadly stable, and these have been supported by diversified foreign exchange inflows, domestic forex market reforms, and increased confidence in the economies of these countries. And as we advance the East African Community Monetary Integration agenda, we must also reckon with the growing role of artificial intelligence, big data, and digital innovation in finance and the wider economy. These technologies are reshaping labor productivity and income distribution, diversifying financial products and payment systems, and transforming how we assess inflation dynamics, monitor economic activity, detect financial sector vulnerabilities, and communicate policy decisions. They present real opportunities to improve the timeliness and quality of policy making, but only when accompanied by governance frameworks commensurate with the risks that they introduce. As a region, we must design shared artificial intelligence strategies and policies that integrate our systems, capture these benefits, and close the door to regulatory arbitrage, including a harmonized EAC framework for regulatory sandboxes and innovation hubs, and a regular strategy for financial inclusion. At the same time, deepening our financial markets remains a strategic priority. Deep, liquid, and efficient markets mobilize savings, support investments, improve price discovery, and strengthen monetary policy transmission. We are seeing growing interest in instruments such as derivatives for hedging, foreign exchange, interest rates, and commodity price risks. These instruments can sharpen risk management and market efficiency, but only when they are matched by strong regulatory oversight and market infrastructure, so that innovation strengthens financial and macroeconomic stability rather than amplifying vulnerabilities. Harmonized market conduct supervision, aligned with international best practices, and paired with robust consumer protection, should therefore be a shared regional priority. Rising public debt across many of our economies presents a further challenge. Preserving macroeconomic stability increasingly depends on close coordination between monetary and fiscal authorities, while safeguarding the operational independence of our central banks. And such coordination is essential to keep debt on a sustainable path, anchor inflation expectations, and preserve policy space we will need to respond to future shocks. We continue to explore innovative ways of strengthening our external and financial partners. One such avenue is the operationalization of central banks' domestic growth practice programs, which can support reserve diversification, strengthen reserve adequacy, build resilience against global financial market volatility. Sharing experiences and best practice in this area offers valuable lessons as we work to build stronger, more durable policy buffers. In advancing financial inclusion, it remains an equally important collective effort. East Africa remains a global leader in digital financial services, particularly in mobile money, and we must keep leveraging technology to widen access to affordable financial services for households, small businesses, and the underserved communities. The EAC cross-border payment system master plan is central to this drive. Advancing greater inclusion and interoperability, lowering transaction costs, supporting economic empowerment, sharpening the effectiveness of monetary policy, and contributing to more inclusive and sustainable growth. So we should therefore remain and continue to examine candidly the efficacy of our convergence criteria in light of the new realities and the uneven programs our partner states have made against macroeconomic convergence targets, and propose concrete measures to accelerate our shared path towards a single currency by 2031. Our commitment to a monetary union is not in question, but a candid review shows that we are consistently falling short of the convergence criteria, including reserve and inflation targets that falls squarely within the central bank mandates. Continued divergence from these criteria is eroding the credibility of our shared vision of monetary and political integration. For correct course, we must strengthen peer review mechanism and anchor binding national action plans, rigorous fiscal consolidation guidelines, and harmonized policy frameworks enforced through transparent regional surveillance and compliance protocols. And I must commend the EAC Secretariat, the technical working groups, and the staff of all our central banks for their dedication in advancing this agenda. I'm confident our deliberations will yield practical steps to strengthening monetary cooperation, promoting financial stability, deepening our financial markets, and share innovative approaches to reinforcing our policy framework and buffers amid an predictable global environment. Above all, let us work to remain anchored in the greater goal we serve, social and economic transformation of our region. With these remarks, it is my honor to officially open this meeting of the East African Community Monetary Affairs Committee. And I thank you all for your very kind attention.
2% of GDP in 2025. However, recent external shocks contributed to the modest widening of the deficit up to 2.4% of GDP in the year ending June 26. To strengthen external resilience, we are implementing strategies aimed at promoting exports and supporting import substitution. At the same time, we continue to enhance our foreign reserves position through our gold purchase program, which currently stands at over USD 6.0 billion, excluding the non-monetized gold. This is equivalent to 4.5 months of our import cover. It is meeting the minimum EAC convergence threshold. Including the non-monetized gold holdings, our gross international reserves will amount to approximately 80.7 billion USD, and this will be equivalent to around 80 months of our import cover. On the fiscal front, the budget deficit is estimated to have narrowed to 3.1% of GDP at the end of our fiscal year 2025-26, which means by June 26. This is supported by improved domestic revenue mobilization and improved expenditure management. This represents further growth towards the regional convergence target of 3% of GDP. Public deficit has remained sustainable over the medium to long term, which is estimated at 9.6% of GDP in present value terms, and this is below the EAC convergence benchmark of 50% of GDP. The financial sector has remained sound, stable, and resilient to shocks. The banking sector, for instance, remained profitable with capital buffers sufficient to withstand short-term shocks. The non-performing loans ratio currently stands at approximately 2.9%, a significant improvement from the peak of warm welcome and hospitality. I also take this opportunity to congratulate the Bank of Uganda on assuming the chairmanship of the MAC.
The Central Bank of Kenya remains firmly committed to working alongside the other partner states central banks to ensure the successful execution of our regional integration mandate. Let me also thank the technical officials of the EAC partner state central banks and the EAC Secretariat for the hard work they have put in to deliver the report for consideration during this meeting. I'm happy to note that progress has been made in implementing the decisions taken by this committee in a meeting held in May of 2025 in Mombasa. I especially wish to note that we are progressing well with the modernization and harmonization of our monetary policy frameworks, strengthening our data collection, analytical and risk management frameworks, deepening policy coordination efforts, particularly with regard to information exchange and joint research, propagating the use of the East African Payment System, the EAPS, to facilitate regional trade, and finally, building human capital in various areas of central banking.
Brother Michael, Governor of Uganda, and the chair of 29, Mark. Dear colleagues, I would like also to sit on the protocol that has already been established. I would like also to recognize the presence of Madam Lindsay, who has been very instrumental to support us through this movement at the EAC. Dear colleagues, ladies and gentlemen, a very good morning to you all. Chair, allow me to begin my remarks by thanking the Almighty God for granting us good health and the opportunity to convene here once again to deliberate on matters that are critical to our region's economic integration agenda. I also wish to join my fellow governors in expressing our sincere appreciation to the State of Uganda for the warm hospitality and the excellent arrangements extended to me personally, my delegation, and all other delegates since we arrived. When we arrived at the airport, we were received very well, and I have seen the weather here is also very conducive, similarly, almost like the Dodoma. So we thank you very much for that. The gracious welcome and the excellent organization of this meeting have made our stay here both productive and memorable. I would equally like to commend our technical officials for their diligence and dedication, preparation of the reports that will guide us on this deliberation over the course of this meeting. During the briefing, I've seen documents that have been well prepared, and we congratulate all of them for these commitments. Dear fellow governors, this year, 2026, marks a significant milestone for three central central banks in the EAC. Of course, the Bank of Tanzania, Bank of Uganda, and the Central Bank of Kenya, as we celebrate our 60th anniversary. Celebrations on that was presented on 12th June 2026. I also extend heartfelt congratulations to our host, the Bank of Uganda, on attaining this noble and remarkable milestone. This milestone reflects the case of dedicated service to monetary and financial stability, and the steadfast commitment to national and regional development. So, governors, we are meeting at a time when our region is navigating an increasingly complex global economic environment, compounded by the ongoing conflicts in the Middle East. These developments have heightened uncertainty and tested our ability to respond effectively to external shocks. This meeting, therefore, provides an important opportunity for all of us to reflect on these challenges and align our policy responses. I firmly believe that strengthening our resilience to external shocks require greater coordination and closer collaboration among our institutions than ever before. Equally important is the continued harmonization of our policies, regulatory frameworks, and financial systems to accelerate regional integration and deepen inter-trade among our region. I'm pleased to note that our technical officials have put forward several strategic initiatives for our consideration and approval, which I believe they will have gone through the documents that will make even this meeting to be more productive and shorter. Fellow governors, allow me to briefly share some recent economic developments for the case of Tanzania. Our economy continued to demonstrate resilience in 2025, where we recorded a GDP growth of 5.9% in 2025. Despite a challenging external environment and the foreseen global economic shocks, growth is projected to increase to 6.3% in 2026. While this performance is encouraging, it remains below the pre-pandemic average and the EAC benchmark of 7%. This suggests that there is still room to accelerate economic growth through sustained reforms and enhanced productivity. Inflation has remained within the national target range of 3 to 5% and consistent with the EAC convergence criteria of a maximum of 8%. Nevertheless, the recent acceleration of tension in the Middle East